Hi all, welcome to my YouTube channel Banking Regulation Simplified. In this channel, you will understand the latest trends of banking regulation, understand in-depth concepts of banking regulation, and also you can use this YouTube channel to catapult your career in the world of banking regulations. Good luck. Hi all, welcome to another video in our channel Banking Regulation Simplified. In today's video, we shall see the history of Basel Committee. So in the previous videos, we had seen an overview of banking regulations. We saw an in-depth we got an in-depth understanding or had a deep overview of some of the important bodies behind banking regulations, which is BIS, Bank for International Settlements. Under that, there is a subcommittee known as BCBS, which stands for Banking Committee for Banking Supervision, which is the apex body behind banking regulations like Basel Accords 1, 2, 3, 4. So, BCBS, Basel Committee on Banking Supervision, is a key body if you have to understand the world of banking regulation. So, today we will see the history of Basel Committee. So, let's get into this video. I hope the screen is visible. Just in case the slides are not visible, I'll attach a copy of the slides towards the end of this video. Now let's get to the video. Origins 1974-75. This period was a very chaotic period due to the failure of large banks and banks which were primarily dealing across borders, like dealing with for FX settlements and foreign exchange conversions and FX derivatives. History wants us to remember two names, two banks which were crucial behind this chaotic period. One is Bankers Herstatt, a German bank, a relatively small bank. The other one is Franklin National Bank, US, based out of US. It was a little bigger bank. On a comparative scale, the losses due to the collapse of Bankers Herstatt was $200 million, whereas the losses due to the collapse of Franklin National Bank was $1 billion way back in 1974. $1 billion way back in 1974 is a huge sum. Okay, so what had happened is it created panic, ripples, lack of trust, and suspicion was heavy and thick in the air. But the one important point was people started losing trust in the banking system, and banking regulators and bankers also understood that when you're going to deal across borders, tap onto the era of globalization, there are many risks which you may not be aware of even when you're dealing with your part of the business, which means that is a complete lacuna for the regulators as well. Meaning, whenever you step outside your borders in the aim and aspiration of growing your business and expanding your presence, there are a lot amount of risks which are unseen or which cannot be seen by naked eye, or probably risks which have become part and parcel of the cross-border trading or the globalization era. So this made world countries understand that lack of trust and suspicion was thick in the air with respect to banking industry from the public, and they need to restore confidence of the public in the banking industry. So what they did is, in response, the major countries, the central bank governors of the G10 countries, Belgium, Canada, France, Germany, Italy, Japan, Netherlands, Sweden, Switzerland, UK, US, plus Luxembourg, created the Basel Committee on Banking Supervision in December 1974 under the Bank for International Settlements. Okay, the goal was simple: improve international cooperation in banking supervision and close regulatory gaps. Meaning, banks need a rear guard, banks need an ombudsman to monitor them, to guide them, to rein them when they're taking unnecessary risk, or when the risk is out of proportion with respect to their own business model or with respect to the banking industry. So all this would come under the ambit of BCBS from 1974. Imagine 1974 was nearly 50 years, more than 50 years back, when banks had just come out of the World War II, economies have come out of the World War II, and the Bretton Woods agreement was scrapped. So there was very little direction on how the global economy will move, how the banking industry would perform. In the backdrop of this, there were two huge failures on either side of the Atlantic. So you can imagine how toxic or how difficult or how vulnerable or fragile the environment would have been. So it was right on the part of these major countries to create something known as BCBS to address the situation, and BCBS set on to the task right away. But the History of Basel Committee, like I said, it's a think tank. It studies, monitors, thinks, drafts plan, then explains the plan, publishes them, but does not oblige anyone to follow them. But due to the merit and the deepness and the rightness behind these regulations, the regulations proposed by BCBS have been adopted widely. So let's see the history in the coming slides. Early work, 1975 to 87, it was formed in December 1974. So the first 13 years of BCBS is being explained in the next 1-2 slides. So what it did is, it developed principle for international banking supervision. We understood cross-border banking or international banking in the era of globalization had a lot of risks, which even if the banks are aware, the regulators are aware, it will be still difficult to manage considering the dynamics and the ripple effect or the cascading effect of these risks across borders and the banking industry. So what it did is, it said home country supervisors are responsible for global operations of the bank. Also, the host country supervisors are responsible for the local operations, meaning if a bank were to be started in US, the home country operation regulator, which is Fed, should have an eye and monitor and guide, regulate or intervene into the operations of that US bank in other sides of the globe, let's say Europe. Similarly, let's say that US bank has a branch in UK, the regulator for USA, which was then FCA, should also monitor the local operations of global banks or international banks. So it was kind of a two-way vigil which was enforced, or rather this two-way vigil was the bedrock or the guiding principle for these regulations. So to prepare the ground, to understand the ground and bring everybody to speed or onto the same page, it issued something known as Concordat. It explained what the whole agenda was, what the whole purpose of that exercise was, and issued some guiding principles for all the participating banks. At that time, we saw earlier that the G10 banks or the G10 countries were behind this. So this Concordat was mainly drafted, discussed among these G10 countries, and understood what needs to be done and how the ground needs to be prepared and how the umbrella of the regulation should be designed. So it focused on information sharing, supervisory standards and risk management practices. So this was the ground preparation time taken from 1975 to 1987, 13 years. So you can imagine some organization which has the might of the G10 countries still takes 13 years to prepare the ground for banking regulations, issue guiding principles, make everyone accept. 13 years. And you should also imagine this organization was created on the back of two devastating banking failures. So you can imagine how difficult it would have been for BIS and BCBS way back in the period from 1975 to 87. Okay, but most of the hard work was done. The only sore point is it took 13 years, not to forget. The next or the first Basel Accord was released in 1988, known as Basel I. If you were to compare it today's version of Basel Accords, which is Basel III or Basel IV, this will look like a kindergarten syllabus, to be honest, because this was like always, anything first will be very primitive or simple when we look back, but it's laying the groundwork. So what it did is it laid the groundwork, meaning it introduced something known as capital adequacy requirements. This term and these conditions are still consistent 50 years till now. 50 years, I think it's close to, well, nearly it's going to be 40-50 years since the Basel I was introduced. So these terms are still consistent. And so what did this quantify, assess the amount of risk in the bank's balance sheet and set aside 8% of it as safety cushion. Though it may sound simple today, way back in 1988, going and telling banks all over the world, or at least to the banks in the G10 countries, quantify the risk, calculate the risk, and set aside 8% of that risk as capital, meaning you go and monitor what it would mean for banks is you go and study your own banking model, understand the risk, identify risk, quantify the risk, then keep aside 8%. Meaning, way back, let's say 1988, if a bank had a balance sheet of $100 million, had a risk of $20 million, 8% of that would mean they need to set aside $1.6 million as capital. So that was a substantial sum, and also something never heard or unheard in the banking industry. But this is where the might of the G10 countries comes in to enforce it. Okay, so it addressed only credit risk. It did not address the gamut of risks, or did not come out with a slew of ratios like it is today. So it was a small step in the right direction. So what it did was, you are a bank, you calculate credit risk. If your credit risk is, let's say, $10 million, you set aside 8%. It sounded simple, but there was a lot of stigma behind accepting it. There was a lot of resistance. But however, it had to be accepted. But however, since it was early stages, there were a lot of loopholes which banks started to exploit in the subsequent years, probably in the 90s, in the era between 1990 to 2000. So, but like I said, this is a step in the right direction. So it introduced minimum capital adequacy requirements, 8% of risk-weighted asset, and catering only to credit risk. So it ensured banks are solvent in all times, crisis, recession, or default, or major body blows to their own banking business model. Anything, they are always solvent, which would mean their survival is crucial, and for their survival they need to set aside capital. This was the idea imbibed or inserted by Basel I Accords. So it was widely adopted by over 100 countries, not just BCBS members. So that explains, like I said at the beginning of the slide, it is not a mandatory organization or an organization which can enforce its regulations, but it's more of a think tank or a meritocracy or merit-oriented organization which studies the banking system, has enough intelligence and understanding, so it tells what needs to be right, what needs to be done to ensure we are safe for the banking industry and the global economy as well. So considering the rightness and meritocracy behind this principles or the accords, it was adopted by 100 countries before the end of the century, which is before 2000. Now let's move on. Like I said, in 1988, though there was a lot of resistance, stigma behind adopting it, banks adopted it without any other option. But slowly, in the due course of adoption and living with those regulations, they identified loopholes and started exploiting the loopholes. So the very idea or the very principle of ensuring banks stay solvent when the risks are identified and assessed and calculated was diluted or negated. So, like I said, this is more of a reactive field. This is not a proactive field. This is always playing catch up or behind the curve of the banking industry. So then, 1980 to 2004, intermediate period of 16 years, was used for implementation of regulations of Basel I, then studying the impact of those regulations and also studying how effective it was. And there are small little crises here and there. So BCBS was also checking how this Basel Accord was helping the banking industry from collapse, and also ensuring the global economy or the economy was not getting impacted. So it was more of a back and forth approach of introducing regulations, studying the impact, following the implementation, ensuring implementation, then studying the strength of the regulations in the back of an adversity. It was more of a mixed approach towards evaluation and implementation of the Basel I Accords. So in 16 years later, the next version of Basel II came in 2004. So this was more risk sensitive. Like I said, Basel I was more crude. It told banks to qualify or quantify the credit risk in their books, set aside 8%. Banks adopted it but exploited loopholes. And in the meantime, over the last 16 years, there were a lot of risks which emerged, like market risk, the risk of loss in a market for a bank, in other words, the risk of loss in market for a positions held by the bank or a bank for its customers. Then operational risk, the risk due to errors or frauds in the banking business. So Basel II brought calculation methodologies for those two types of risks also, which is market risk and operational risk. So this also introduced something known as three pillars, which is still existent, which will still exist in the years to come. The three pillars, which we'll see in depth in the coming videos, but I'll slightly touch upon. The first pillar stands for minimum capital requirements. So it encompasses of credit, market, and operational risk. Supervisory review process, in other words, the supervisor for the regulator or the regulator for the respective banking location or for the bank's jurisdiction will go and check the implementation of these regulations in the bank. So this was not there before, and this was required because after the implementation of Basel, when we found banks started exploiting the loopholes in the banking business. So some kind of a regulator intervention is also required to ensure correct implementation of the regulations. Then market discipline. So it's not enough if you just calculate and report risks to bank, your regulator, and your regulator just comes and once in a while comes and checks the implementation. That's not enough. Apart from that, there is something known as market discipline, meaning you quantify the risk, you report the risk to the regulators. After some time, let's say after a cooling period, after reporting the risk into the regulators in certain template formats, the same information is reported to the public, published on your website, or probably published in newspapers and magazines. That will give information on important risk metrics of the banks, like the amount of risk under these three categories, the amount of capital. Apart from that, certain important risk parameters, and also the overall health of the bank through which some inputs on the balance sheet and the profit and loss. So this was also unheard of or unacceptable in the banking industry, because anything new and rigid will always find resistance in any walk of life. Banking industry is no exception. So 16 years back, they were asked to quantify and report and calculate and set aside money. 16 years later, they were asked to calculate risks for few more types of risk, namely market and operational risk, and they were also told regulators will come once in a while and check the veracity of the implementation in your banking model. Aside to that, you have to go and disclose to the public whatever you disclose to the regulator. So it's game changing, it's a paradigm shift. But by 2004, banking industry had grown by leaps and bounds and started taking excessive risk. So Basel II, though it may sound advanced and adequate or probably highly thought about, in comparison to Basel I, was not adequate comparing the ground realities. Let's see. Okay. So it encouraged banks to use internal risk models, what we normally call now as IRB, internal risk-based methods. The crux of this is, if regulator were to give a methodology and a formula and a ratio to calculate and quantify and keep asset capital, banks on the same hand will have option to calculate their own risk through their own formulas and methodologies and keep capital as a percentage of that outcome. Meaning, if a regulator methodology is quantifying your risk to be 10, banks can use statistical models to quantify the same risk as 5, meaning they can lower the risk and thereby set aside the capital. The capital required for that also will be lesser. Meaning this gave a lever or a strong weapon in the arms of bank through which they can game the system. Meaning they can use internal models to quantify, to lower the amount of risk quantified and to set aside less capital. Meaning they will have a cushion or buffer if they had to follow whatever the regulator told, but on the other hand, when they do it by their own means and methodologies, it will be substantially lesser. Meaning that extra money they can use it for deploying in their business or for other business activities. Okay. So, but however, this is an industry which is not proactive but reactive, and which focuses on quantifying the risk and setting aside capital. And if you are going to give a lever through which the risk can be reduced and the capital set aside can be reduced, that is not good. When the ground reality of the banking system had changed. Okay. So this was the biggest drawback of Basel II, the pro-cyclical and underestimating risk, meaning When things are good for the economy and the banking industry, banks will lend a lot more, qualify or calculate little risk on their books and set aside little capital. But when things go bad, this when meaning the amount of risk they calculate on their own banking models or business will be much higher. The capital which they had set aside on the basis of lower estimation will be less or minimal to help them survive the crisis. Okay, this is what exactly happened in 2007-8 crisis. Okay, so now we come to Basel 3. So Basel 2 was introduced in 2004. Basel 3 was introduced from 2010 to 2017. Earlier versions of Basel had 1 year of launch, but this was a multiple year of launch because for a simple reason, it studied the 2007-8 crisis closely and found out that Basel 2, though created the pillar approach, included a lot of risk, gave the key or the steering wheel to banks through which they can game the system and reduce the risk, which was not good for the safety of the banks, especially in an era when they are looking at to take a lot of risks. Okay, so what happened in 2008 global financial crisis? Banks which had grown by leaps and bounds, increased their balance sheet through aggressive lending and through designing of exotic products where profit was aggrandized. When things went wrong, they all fell like a pack of cards, and the capital which they had set aside for their own safety or rescue was minimal or little, and we saw a lot of banks failing and a lot of banks on the brink of failure. Namely, history wants us to remember two names: Lehman Brothers and Bear Stearns. Lehman Brothers failed, Bear Stearns was bought. Okay, so 2007-8 was something similar to what the world witnessed in 1974-75, where two banks failed. There was suspicion, lack of trust, which was thick in there. The same, nothing less. Okay, but by then the bodies like BIS, BCBS, FSB, G7, G10 are all matured and were well equipped to handle such crisis. So it was relatively unscathed, but the wounds were very deep. Okay, so what it did is it promulgated a few reforms on the primary principles: higher quality and quantity of capital, focus on common equity. Common equity means, in other words, something which is equivalent to cash or cash, which needs to be included as part of the capital buffer or capital ratio. Then liquidity standards, liquidity coverage ratio, net stable funding ratio. Liquidity coverage ratio, in other words, banks need to set aside high quality liquid assets which are required for 30 days of their own period for their own requirements, meaning it takes a value of the inflows and outflows. Then net stable funding ratio, meaning whatever money you need for next 12 months for your salaries, maintenance, dividends, payouts, whatever it would be, needs to be quantified and that needs to be set aside. Meaning there are two terms in this: available stable funding ratio and required stable funding ratio. Required stable funding ratio divided by available stable funding ratio should be greater than or equal to 100%. Okay, aside to that, it created something known as leverage ratio. The leverage ratio is a game changer. What it did is, generally in the history of things, exposure was calculated was the primary number, then risk weighted asset or risk was the secondary number, and a proportion of that risk was kept aside as capital ratio, which in some cases is 8%, 10%. Okay, so though the exposure was high, the risk was reduced through the use of internal bank models and capital was substantially reduced because the secondary component, the risk weighted asset, was reduced. So what leverage ratio did is, though the risks are quantified less and the capital set aside less, in terms of crisis the capital is not adequate to safeguard a bank. So what it did is, it linked the capital to the exposure, meaning capital divided by exposure should be greater than or equal to 3%, and that capital should be only tier 1 capital. There are many types of capitals promulgated by Basel. Out of that, tier 1 or CET1 is very important, which we shall see in the upcoming videos. So it was a phased implementation from 2013 to 2019. Some elements extended until 2020s. Okay, we are the final version of Basel, current version of Basel known as Basel 4. Okay, so it's an offshoot from Basel 3, but industry wants to call it as Basel 4. Primarily, it's a amalgamation of multiple BCBS papers. In some jurisdictions like Hong Kong, Singapore, it has been accepted. In some jurisdictions like UK or USA, it's yet to be accepted. So, but let's say 5 years down the line, we'll be seeing more of a Basel 4 regime across the global banking industry. So what it does is, it's an amalgamation of various papers by BCBS. The industry wants to call it as Basel 4. So now banks have the option of calculating their own risk, which is approved and supervised by regulators, but still the variability of risk quantified by banks for the same jurisdiction or for the same business model is highly different. So it wants to reduce the variability of the risk-weighted assets calculation. So it has introduced certain key changes. So the standardized approach or the supervisor suggested approaches for Basel 4 for credit risk, market risk and operational risk. And apart from that, something known as output floor, which is a game changer, just like how leverage ratio was a game changer in Basel 3. What output floor does is, if the supervisor devised or advised risk weight is at 100 and the bank's own methodology calculates the risk weight as 50, we see a scathing gap of 50, or the supervisor risk weight is twice as the bank's estimate, or in other words, the bank's estimate is half of the supervisor estimate. So what it does is, it has advised something known as output floor, meaning the output of the risk weight assets calculation for a bank through its IRB method should not be less than or equal to 72.5% of the standardized method, meaning it reduces the gap between the IRB output and the standardized method, meaning banks can no longer reduce their RWA through the internal model estimates. Even if they were to reduce, it should not be less than 72.5% of the standard RWA. Apart from that, what it does is, it will slowly wean away the impetus or the benefits behind IRB models and slowly transition everything towards a standardized regime, meaning the amount of risk calculation will be standardized for all the banks. There could be small modifications for each jurisdictions decided by the respective regulators, but more or less it will be uniform, meaning it will be uniform, the implementation will be uniform, the calculation will be uniform, and meaning from a regulatory lens, things will be on level playing ground for all banks in all jurisdictions and for all sizes. Okay, so the implementation is scheduled from 2023 to 2028. Primary reason is delays due to COVID-19, which was a body blow, because there were defaults, there was lack of business or revenue, but still banks managed to come unscathed mainly on the back of the capital buffers. So on the back of a severe crisis like COVID-19, if banks are asked to implement Basel 4, which would mean much more capital allocation and much more preparation, so they asked for some relaxation in implementation, which was right on the part of the banks and was also agreed with the regulators. So Basel 4 implementation will be somewhere between 2023 to 2028. For certain locations, it could stretch until early 2030s as well. Okay, we come to the end of the slide. This is about me. So like I said, if the slides are not clear, I'll attach a copy of these slides at the end of the video. I hope you like this video. For more such videos, like, share, subscribe. Thank you.